Hello, Lifestyle Investing. My name is Bernie.
I'm Mike.
Where we are investing based off our lifestyle to build that future lifestyle. I'm super excited.
Me too.
Because last video, Mike was talking about the correlation with bonds. He talked a little bit about what they are. They got some foundational. How you're essentially just buying debt from the government, right? It could be a city, a state, the federal government, and it could be. Internationally, different countries. You could buy a bond from Spain, from Japan, things like that. But essentially, the government. And he was going in depth about the correlation between rates and bonds.
Yes. Yeah.
So I'm like, what's going on in part 2, man?
All right, part 2.
Yeah.
Well, we can talk a little bit about the.
You give me a weird look, man.
I know, right? I'm like, I think I said it all in the last video.
So what else am I going to talk about?
Right, exactly. Well, so closely connected in the whole discussion of bonds and mortgage is the Federal Reserve when they meet every quarter to talk about the prime rate, which is the rate that's on your credit cards, and the rate that is on the variable rate stuff like home equity line of credit and stuff like that. That is basically what the bank is borrowing the money from the Federal Reserve at. So the bank borrows the money and they give it back. And as we know, we both worked in retail banking. Armored car comes every day, brings money, takes away money. It's really a trippy thing.
Yeah.
It's like, why can't we just keep that money for tomorrow? But it's just because it's that closely managed. You know what I mean? Like hundreds of thousands of dollars.
Oh, yeah. Kind of so I have a question, right?
Yeah.
So let's say the prime rate goes up, and this won't happen.
Yeah.
But let's say it, Janet and those other people, they're like, hey, we're going to raise it 1%. Right, which is extreme. But let's say it goes up 1% tomorrow. What happens to bonds?
That's a good question because it's not directly related. But what'll probably happen is they'll go up because they know that the people who are buying the securities that are backed by things that have the Fed rate attached to it, that they're going to leave the bond market and go there. So it's all a competition. It's like supply and demand.
Oh, yeah.
Yeah, and so the one thing that reminds me that I wanted to talk about was the government, Janet and the Fed Reserve, when they meet, when you hear about the Fed meeting, what they've recently said is that they're going to start tapering, which that word means they're going to start cutting back how much money they're actually putting into mortgage-backed securities. So they've been putting billions and billions of dollars every quarter into the mortgage securities to keep the rates low. Because it's supply and demand. If a bunch of people are buying them, you can charge less. If less people are buying them, you got to charge more to make the money, right? And you actually have to, the price of mortgages would go up because they would need to attract investors. Right now, they're not too worried about attracting investors because the government, the Federal Reserve, it's not really the government, but it feels like it is. But the Federal Reserve is putting so much money in there that the mortgage-backed securities rates can basically stay low, which means 30-year mortgage rates can stay low. But as soon as they start pulling their money out, they're going to need to find more investors, which means they'll make the rates higher so they can pay out the investors. So that's going to happen. The tapering is going to happen, which means they're going to pull their investment out, which means the mortgages are going to go, the mortgage rates are going to go higher because they need more investors, which ultimately will affect the bond rates because the government still needs to get their money in, so they're going to try to compete.
And another thing that I know of is that I don't know your thoughts too is so when the rates are low, right? Banks are going to be investing less in lending, right? Since the rates are low, since they won't make too much money on, and instead they'll buy bonds. Okay. Right. So then the bond market kind of goes up from there. As they go up, then banks are like, hey, we're gonna make more return on there, so we're gonna sell the bonds and buy a bunch or invest it all in mortgages.
Yeah, basically hiring loan officers and
exactly
that kind of thing.
So the money goes all towards lending instead of having their money in bonds. So then that affects it in that sense as well.
Yeah, and I haven't really gone too deep into that on the higher level of banking, but I do know that there's certain appetites at certain times. Depending on the market, they will say we're going to dump a bunch of money here, or it seems like when you and I both were working at Bank of America, they were pouring a ton of money into the mortgage, and not only just mortgage but purchase. They were trying to figure out how do we get into this purchase market. They were seeing, before we really could see it, they were seeing a huge potential and uptick in the purchase market. So they have advisors, they have people that are saying, hey, spend resources. because they were pulling MLOs in from everywhere. I mean, every branch had an MLO for a while, you know. So I mean, they were definitely pulling it in.
Yeah. It's definitely very interesting, you know. But at the end of the day, it's as simple as, you know, if you can get a better return on the bond or a better return on a mortgage-backed security, right?
Yeah.
So institutional investors will just go each route, and so depending on you know what the rate is at that time, it's going to influence where to go. So as kind of Mike was saying, like there's not a direct correlation. Right. But the market figures
it's competition.
Yeah, it's just straight up competition. If you can make 4% here, 5% there, why would you leave your money in the 4%? You just sell and then go on the 5%.
Especially when you're doing it in such a huge volume.
Oh yeah. And when these pension funds and these huge hedge funds and whatnot, they got literally $100 billion, right? They make a shit like just a 20% shift, and like that's huge. Yeah. Right.
Millions.
Yeah.
Per day, probably something ridiculous.
It's absolutely fascinating.
Yeah,
absolutely
it is.
Fascinating.
It's amazing. Yeah.
Well, we're at 6 minutes. Do you got anything else you want to say?
Something funny that where you might think about what a savings bond is to you, or what a bond is to you, is a savings bond. So, like, Grandpa sends you a $50 savings bond. That's a government loan. That's a loan given to the government.
It's true.
And you can read right on there. And I remember when I was a teller working at banks, you'd have people come in with stacks of them. And some of these little $50 bonds, we were cashing out for like $500 because it was 10, 20 years down the line. So compounding interest.
Compounding
interest.
Pretty amazing. We're going to have a talk on
we're going to have a talk.
Because that is freaking amazing.
Yeah, it is.
Yeah. Besides, that's like one of the most powerful things. Besides a glacier, that's the most powerful thing on Earth.
It's compounding interest?
Yeah.
What about elephant?
You heard it here.
Elephants
Mike,
and glaciers.
Yeah, elephants, glaciers, savings bonds, Einstein, compounded interest. Yeah. We're making fire. We're investing. We know you are too.
That's right.
We're excited for you to see our next video. Boom.